Hello, welcome back everyone. Thanks for joining me again. And if this is your first time here, this channel is about home financing, saving money at home, mortgages, real estate, home buying, home selling, everything to do with your home finances. So I'm sure there's going to be plenty of content here that'll interest you, and so therefore I would appreciate you if you would subscribe to the channel and see what else I've already created and watch the new ones that I will release soon. So this video is about debt to income, and it's really an explanation of what it is and how it impacts your ability to qualify for a mortgage. And I'm making this video because I really had two people in the last couple of days ask me about their DTI, and they didn't really have an understanding as to what it was. One person said, yeah, I spoke to a lender and they said I wasn't approved because my DTI was too high. And I asked them a couple follow-up questions to that, and it became clear that they didn't even know what DTI was. They just took the explanation from the lender they spoke to and just went on their way and started searching on the internet and found my website and then called me, and here we are. So debt to income and the debt to income ratio is as follows. It's pretty simple. It is all of your monthly payments that appear on your credit report, plus the proposed mortgage, principal, interest, taxes, and insurance, and homeowners association fees, and PMI if you have any, all of that combined, divided into your gross monthly income. That's your DTI ratio. So let's break that down for a second. Let's say you make $60,000 a year before taxes. That's $5,000 per month. If you're a salaried borrower, or you're going to be using your gross monthly income, and so that's $5,000 per month. Let's say the DTI is let's say your total debt, what I was just describing before, all of your payments and your mortgage, future mortgage payments, everything combined is $2,000 per month is what the proposed total debt would be after your new mortgage. 2,000 divided into 5,000 is a 40% DTI. Okay. Now you could probably go to 43% comfortably, but that would be a 40% DTI. Now, when you talk to a lender and say, how much can I qualify for, that's really what they're looking at as your DTI. They're going to take your income, they're going to look at they're going to want to run your credit report to see what's on it, to add all that debt to the proposed new mortgage, okay? And that's how they figure it all out. Now, unfortunately, if you're self-employed, you're going to have to qualify using the net income on your tax returns after all of your deductions, which is what makes it so difficult, because if you're using the right accountant and they're creative enough, they're trying to save you from paying too much in taxes, and they've got a lot of write-offs, and you might be showing a very low net income or even a loss, which makes it difficult for you to qualify. But therefore, there are other mortgage programs for you, such as bank statement loans. Anyway, let's go back to DTI. So you can see how your debt to income is extremely important when it comes to qualifying for a mortgage, and it's important to keep those other debts and obligations and monthly payments that would potentially appear on your credit report down, or get them eliminated, which means if you have credit cards that have a high monthly minimum, which most of them don't, you'd want to knock that down. You don't want car payments. That is a killer. That really impacts your DTI. Okay. Obviously, if you're paying alimony or child support, that's a big one. But back to the car thing. Too many people, they'll go and buy a car, within 6 months of shopping for a house, and now they're finding out that their DTI is too high. They've got a $400 to $600 car payment, and they weren't thinking, or they just didn't know. Do not buy a car before you're shopping and going for a mortgage. Okay, do not do that. I'm sure whatever it is you're driving, you can hold out. Later on, after you get your mortgage and you close on your home, you can go get a car. Those auto dealers will give anyone a loan. You don't have to worry about it, okay? You can be dead. In fact, I think one of my neighbors years ago, he was dead and he got a loan. He got a car loan. I'm not talking about, being like emotionally dead or anything like that. The guy was dead. His wife took the loan out in his name. He was dead. He could have voted in Chicago too, probably. So I didn't even get to drive the car. He was dead. It's easy to get a car loan. One time my wife got a car loan. We put the loan in her name, and the guy asked if she had a job, and I said, yeah, she works for me. And he looked at me and said, how much does she make? I gave him a number, and there you go. She got the car loan. It's that simple. Not the same with mortgages. Keep the car loans out of the picture. Don't do it. Do it later. Okay, so the other thing is when you're shopping for a home, the property taxes and potential homeowners association fees are going to be huge. That will eat into your buying power and your DTI. So if you can, find a home or a town where the taxes are lower, and if at all possible, buy a home or a condo that doesn't have any or has low homeowners association fees, because that will eat into your DTI as well. So if you have any questions on this at all, just leave the comments down below, and I'll answer them pretty quickly. If this helped you, I appreciate you hitting that subscribe button again, and I'll see you next time. I'm going to release another video tomorrow. Have a great day.